They're not looking after you as the LP. Okay. They're not looking for the GP, right? They're looking after themselves and their own profits. So they're going to do whatever it takes for them to get their profit out of it. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello, welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. And it's already basically June. I was thinking about that. The year is it's not halfway over, but it's a fifth, or not fifth. It's 5 months through, and hopefully your year is going well. And if it's not, I think you got to reflect back and say, what are we doing? What are we doing right? What are we doing wrong? Regardless, I do that all the time, and keep on kicking butt here because it's going to be halfway over before we know it. And you have goals that you set forth, and those goals are not achievable if you're not putting those steps in. And it's all about the little steps, and it's all about what you did today that makes you better tomorrow. So we got to continue to push every single day to make ourselves a little bit better. And some days it's frustrating because it doesn't feel like we accomplished anything. But if you put that little bit of effort in to continue to make it a little bit better and reflect every day, what did I do today that helps me in my journey, helps maybe I achieve my big goal, right? We've got big goals. We want to purchase a lot of properties this year. That's one of our big goals. We're likely not going to hit those goals. Maybe things change here, but we haven't purchased a building in 2024. We only purchased one last year. That was a disappointment, but there's reasons for that. And it's not for a lack of trying. It's not for a lack of moving forward every single day. So that's the key, is to remember, okay, and that's why one of the reasons why I chunk down my goals. Not only do I have a goal of purchasing a certain amount of real estate every year, we wanted to purchase $75 million worth of real estate this year. And we knew it was going to be a slow year. We really wanted to purchase more than that, but we said, well, I don't think that there's going to be as many deals, especially in the first part of the year. So let's be a little bit more realistic, but still have a stretch goal. And so that was 75 million. Now, will that happen? I don't know. I doubt it, but we're still pushing forward. We're still have our eye on that goal and to make the steps that it takes to get there. And so we not only had our goal, but we have, what do we need to do in order to hit that goal? And we're doing those things. And now we're saying, okay, well, we're doing these things, but we're not hitting the goal. So what do we need to do even more or differently in order then to hit that goal, right? And to be able to push forward and to get to a spot. And maybe that goal doesn't happen in 2024, but let's make sure we're at least heading in the right direction and getting closer to that goal. And so we can hit our goal in 2025, 2026, and moving forward and continue to grow the company the way we want. All right. So here's what I want to actually talk about today is, so I have talked with a lot of investors, a lot of potential investors, and I've been talking about, LPs lately, limited partners, and some things that I see other companies doing that are wrong, some things that we've done wrong, some things that, things that LPs should be looking out for. And I want to talk about on the LP side. And look, if you're a limited partner, you want to invest passively in a deal, this is good because I get a lot of phone calls or I get a limited partner saying, I don't really know what kind of questions to ask you. What should I ask you? And so I think it's really good and helpful to think about what should you be asking before you invest in an asset. There's some books out there that are great to read, but I want to talk about that. If you're a GP, this is good for you because it's things that I see, that I've seen. I've spoken to thousands of investors and potential investors, and so some kind of reoccurring themes or reoccurring things that I see limited partners interested in. The first thing I'll say, and this is something you have to get over if you're, I think, being responsible. So the first thing that a lot of limited partners are interested in and or think is important, and yet it's probably not as important as what they sometimes get caught up in, but they're very driven with IRRs, with returns. And so they want the highest return possible. And they get excited about if somebody's projecting a 25% IRR, they get excited about that deal. And right away, they want to go for that deal. They don't realize the consequences of going after that deal. They don't realize that, yes, they could get a 25 IRR, they could get a 40% IRR, but they could also lose all of their money because likely that 25 IRR, the only reason why it's projected as a 25 IRR are a few things. First of all, it's a high risk deal. It's maybe got some high volatility type capital behind backing it. It's in a rough area. It's got a huge value play. Things like that. Or it's got a very inexperienced group that just drives they're not being conservative at all with their underwriting, so they're just driving their IR up as high as possible because they know that that attracts investors. People are attracted by that big golden payday. But if that is, first of all, that is your investors, at least the majority of them, potential investors, right? It's not your actual investors, it's your potential investors. They're IRR focused, IRR driven. Everybody wants big returns. And I do too. So I don't blame them. But what you need to do is you need to teach them why those big projections are is something to be concerned about. And why, when you show them a 14 or 16 or 12, whatever your projected returns are, IRRs, cash on cash returns, whatever those are, why your deal makes sense for them to do versus that other deal that has a bigger IRR. I've had conversations with other investors, potential investors that are like, hey, I looked at your deal and I looked at so and so's deal, and I decided to go with the other deal because they're giving me better returns. And I'm like, wait a second, they're giving you better returns or they're projecting better returns? Because there's a big difference there. Well, they're projecting bigger returns. Okay, did you look at the risk of the deal? What kind of financing do you have? Well, they have bridge financing. Okay. And how much are their rent bumps? All their rent bumps are this. Okay. How much cash flow is happening during the life of that investment? Well, they're not cash flowing. They're going to sell and they're going to make a bunch of money on the back end. Okay. Understood. So they're projecting bigger returns with a crazy amount of high risk. Okay. And so your chance of getting 25 IRR is there, certainly, but your chance of also getting no return or maybe even negative, you're having to put more capital or whatever it might be, is also bigger. And trust me, I've experienced this as a GP, as an LP. There's different levels of risk in every single deal. One of your jobs as a GP is to communicate that with your LPs, how much risk there is. One of your jobs as an LP is to ask about the risk profile of the deal. What kind of financing is in place? Of course, if it's long-term fixed, it's way less volatile, way less risk. If it's short-term floating rate, lot more risk involved. I don't care what they say, how they protect that risk. Obviously, the more they do to protect that downside risk, they raise a bunch of money to buy a rate cap. That rate cap is, for a long period of time, blah, blah, blah. That's all good, but it still is greater risk. So you just got to understand those risks involved. The less cash flow in the front end and the more return in the back end, the greater the risk. If we're not cash flowing today, we're assuming then that the market behaves in a pattern such that we can then make a ton of money in the back end. And that could happen. And that's great. And hopefully it does. But that provides a greater amount of risk to the deal. Okay. It just does. All right. So that's something, again, as an LP, navigate around, just understand returns, IRR, that doesn't, the higher it's projected, in my opinion, the higher the risk. If you're at a 14 IRR projection, that likely means it's a lot less risk. Not always. We still have to ask our questions and do our due diligence around it, but that likely means it's less risk than something that's projected at a 20 IRR. I've been seeing these advertisements on Facebook. I saw one that was like a 36% IRR, and I'm going, I would never touch that. Never even think about touching that, because those people are desperate, and they're desperate to find investors that are suckers, that just look at the return and say, "Ooh, I like that." And so if somebody's ever project, in my opinion, if you're projecting over a 20 IRR, you're just hunting for those investors that don't want to ask any questions. They're just return driven, and they're looking for that home run deal, and they're suckers, right? And so you want to be careful, in my opinion, of those deals. If you're projecting big returns, likely it's, like I said, either high risk or a company that's just immature and doesn't understand how to truly underwrite deals and be conservative and think about that. The number one job is you want to retain your capital. Number two is you want to make some money. The other thing they ask, I hear asked a lot, is what's your GP alignment? What's your general partnership alignment? So basically, how much money are you investing into the deal yourself? And so if you're sitting here, um, as an LP investor, you want the general partners to be investing, 5% or more of the equity needed. 10% is even better, because you want them to have some money at risk, right? And if they don't have any money at risk, then do they have, as much care if things go south? Now, hopefully the answer is yes, they do. I mean, we no matter how much money I put in, I look at every deal the same. I'm very dedicated to it, and we're going to do everything in our control to make sure we're not losing any GP money, and or sorry, LP money, and we're making as much as humanly possible for the LPs as well. That's our goal, no matter what we do. But you're always a little bit more. Um, uh, you always care about your own money, I guess. And so if you've got more money into that deal, I feel like it motivates everybody, right? Just maybe just a little bit more. And it really motivates the people that maybe don't care as much about the limited partners. So if you end up investing with a GP that doesn't care as much about the limited partners, but they've got a bunch of their own money locked in, well, hey, I guess that's still a win, even though maybe it's a loss because they're not caring that much about their limited partners. But it's a win because they did put a lot of money in there, and so hey, they're still tied to that deal. Um, and fees is the big one. This is a big one. I get asked a lot, like, what type of fees are you charging, and when does that come into play? And so really understand your fee structure and why that fee structure, because investors will ask, like, why are you charging that? Why do you need that much up front, or why do you need that much for asset management, or so on? And so be able to justify your fees, and understand the reason for them. And anybody that questions my fees, because we are fairly light on fees, we're charging usually, a couple percent on the acquisition fee, and usually 1.5% on the asset management fee, and that's it. And then we take our split. And so when somebody questions my fees, of course I answer their concerns, but I also want to make sure they understand, look, part of the reason why we do this is to make money, and I'm not going to be in business to not make money. That just doesn't make sense to do. Now, I want to be aligned with your success as much as we can. We have some fees that we do take on the front end. We have some asset management fees, but like, we pay our asset manager, right? We have continual fees, or continual, dollar amount that goes out the door, that we have to pay for. We have a lot of upfront pursuit costs and that type of stuff. So it's certainly, making some money on the front end is what we want to do, or what we need to do. But we want to align ourselves as much as possible on the cash flow and on the back end sale. And so that way, our investor success is also our success. And that's what I want to see in any type of deal that I invest in, that it's not fee heavy. I saw a deal not that long ago. These guys were charging a 4% acquisition fee. That's really big, a number on a fairly good sized deal. So they were making several $1 million. I think it was just over $1 million up front on a deal. And is that really needed, in that case? And that would be something I would question. And I've seen other deals where they're charging huge asset management fees. Is that really necessary to operate this deal efficiently, or are you just being greedy and taking all the profit? And then how does the splits and fees, how do they actually flow through? If we have a disposition fee, I'm not too opposed to that. But does that come first? Does that come prior to profit to the investors? Or is that after investors meet their specific hurdles, right? So if I've got a disposition fee and the GP has to at least pay 7% preferred return to the investors before that's realized, that's different than if they can take it the second that property sells or refinances, because again, that puts a lot more risk on that deal and my opportunity to get my capital back. So I want to make sure, how do I get my capital back? And am I kind of in first in line to get my capital back, or am I last in line to get my capital back? And the other thing with these splits, and this is kind of a different twist on it, but well, here let me first finish my thought on my splits. Um, for GPs, try to make it less confusing. Okay. So by that, I mean, I don't want these crazy waterfalls where I've got so many different situations that need to happen for investors to get their returns. I want it pretty simple: 7% preferred return, 70/30 split. And once we hit a 12% IRR, it goes to a 50/50 or something like that, right? Or just even the 70/30 and that's it, right? But something fairly simple, not crazy complex. I saw one the other day. It was really cool. I loved it. I thought it was amazing, and they're really being creative. But as I thought more about it, I'm like, man, it's just so confusing. Like, I don't, as a limited partner, I would look at that and I understand the business, I understand the game, but even me understanding it, I was like, wow, this, I have to really think about this and how this flows. And if I have to think that hard about it, it's too confusing for, especially for your typical limited partner who isn't in the weeds on a day-to-day basis like I am. So if it's confusing to you, it's more confusing to your limited partners. So make sure your splits and your waterfall and how everything flows is easy. It's easy to calculate, it's easy to think about, and it's easy to explain and understand. More difficult it is, the more confusion you have, and a confused mind doesn't like making decisions, and so they're not going to do the deal. So just easy deal splits. Okay, so along with that, I want to talk about, this kind of goes along with, I guess, point one and point two, is what type of capital stack do we have? And so typically on the capital stack side of things, we have the loan, and that's in first position, and then you have the equity. And so sometimes that equity gets chunked up. Now, what we like to do is the loan, and then we like to have our investors, and that's it. Okay, that's really easy. But some people slide in a preferred equity group. They slide in institutional capital. They slide in mezz debt. Okay, they slide in something else, and then the investors. And so now we not only have a first, but we have somebody in second position that's going to get the next chunk of profit, and then finally the investors get chunk of profit. When you see those big returns, a lot of times that's the case, is that there's a loan and then there's a second chunk that's getting their money first, and then you get your money last. And so if things don't go exactly as planned, guess who gets the short end of the stick? You, as the investor, are last in line to collect money. Those That second chunk, that the preferred equity, the the mezdat, the private equity firms, the family office, they are, guess what? Getting control of the property if things aren't going the right way. There's carve outs for them. There's all kinds of things for them to be able to step in and do and pull the strings. And who do you think they have that they're looking after? Themselves. They're not looking after you as the LP. Okay. They're not looking for the GP, right? They're looking after themselves and their own profits. So they're going to do whatever it takes for them to get their profit out of it, for them to get their money out. And they don't care about you. I'm sorry. They just don't. So something to definitely consider is, what is the capital stack? What's that look like? And how are you protected in that capital stack? Are we sure we're going to get our money back if things don't go perfect? Okay. The next thing, deal length. I get a lot of people that want to get quick fix and flip, basically. And I get a lot of people that want to cash flow that thing and keep it for a long, long time. Understand as an LP why you'd want to do your strategy, right? The flip is definitely attractive. It definitely can, it's velocity of money. So it moves your money really quickly, helps you make better returns, but a higher risk, certainly. And guess what? You get to pay the government a lot more money, a lot more money. We take a little depreciation, but we keep on paying into the government. So understand that the long-term cash flow, depreciation, we're just collecting the money, uh, continuing to grow that money slowly but certainly, right? And so there's just different strategies for different types of investing for different types of people. Personally, as an LP, I would do both, right? I would have some more fix and flip money, and I would have some more long term conservative type money. Um, how do we get paid, and how do you communicate? These are big, and so I'm I was shocked the other day. I was on a Facebook forum about, you know with a bunch of syndicators, and they were talking about communication, and I was shocked that the vast majority of companies like mine communicate with their investors only quarterly, and sometimes even less than that. Someone will only invest, or someone will only communicate twice a year or even once a year, and they're just giving an update on what's going on with the property and the financials. We communicate every single month. Every single month, we're sending our financials, we're sending an update on what's going on. And so maybe it's too much, but I don't believe in too much. I think investors deserve to understand what's going on and to be able to follow the story. Now, if you don't care, then just don't open the updates, right? But if you care, you have it as an option as a limited partner. So how often do they communicate? Make sure that aligns with what you expect, and make sure you ask that type of question. How often are you communicating with your investors? If it's once a quarter and you're like, hey, I just don't like that, then it's probably not the right group for you. Even if everything else checks out, you want to make sure you're comfortable with what they're doing. If it's once a year and you hate it, well, again, just don't do it. The biggest compliment we get is we communicate really well and sometimes over communicate. But not everybody cares about that. So you got to decide, is that something you care about or not? As a GP, I would highly recommend to over communicate because it just doesn't hurt, right? Even the limited partners that don't care and don't want to see your monthly updates, they just don't open it up. They just don't look. And I get plenty of investors that are like, hey, I know you sent something, but give me a quick, brief update about the property. I haven't opened one of those up in about 6 months. Okay, sounds good. And give them a quick brief update. Say, hey, if you got any more questions, just look at the investor updates. Just get caught up. Great. When are we paid? Most companies are paying quarterly. Some are paying monthly. You got to decide if there's a right or wrong for you as an LP. But the problem with monthly is there's a lot of ebbs and flows in real estate. So how are they protecting from those monthly ups and downs if they're paying out monthly? What are they doing? There's good strategies out there, and so a lot of groups, including ourselves, when we pay out quarterly, we're not necessarily paying out 100% of the cash flow quarterly. We're paying out kind of a a designated amount, and then we make that up as the year goes on if we're ahead of what we've paid out. So let's say we pay out 8%, but in the property made 10% that month. Um, we only pay 8% because we know the next month could make 6%. And so we're not going to, you know, have, we like to keep it nice and even. So we pay out 8%, we pay out 8%, we pay out 8%. And maybe all of a sudden we're like, okay, this is doing really well. We're going to pay out a bigger chunk. And always at the end of the year, we make up any um, difference. Okay. So let's say we paid out $250,000 and we made $300,000, we would pay out that $50,000 at the end of the year if we hadn't paid it out in chunks throughout the year. So um, just understand how they pay out, when they pay out. I think that's important. All right. What else do I have on my list? Look, make sure investors understand your strategy and your deal. Okay. So, what's your strategy? Make it simple, make it easy to understand. And when you're pitching a specific deal, what's the business plan? Make it easy to understand, make it very simple, just straight to the point. Slide decks that are 60 pages, 80 pages long are confusing. Make your slide deck short, concise, and to the point. 30-page slide deck is great. Half an hour, 45-minute presentation is better than an hour plus. Okay, we want to be short. We want to make sure they understand it. We want to leave room at the end for some questions, because it's crazy how every investor has the same question. Okay, so we have a pre-prepared Q&A that we send to every new prospective investor, because we've found so many questions are the same that we get that are on people's minds. Some people ask it, some people don't. So we said, you know what? Look, we're just gonna have this Q&A that every investor gets. That way, their questions are already answered. And then when they have a few more, they can go ahead and ask us. Right? They can always ask us to, hey, I didn't quite understand what that answer was. That's fine, but keep it simple. Simple is better. Make sure they understand it. Make sure it's concise. Okay. Um, let's see here. And look, understand that investors will invest in they want to invest in GPs they really trust. Okay. So you have to build that trust, and you have to make sure your investors are comfortable around who you are as a group, what your business plans are, what you stand for, all that kind of stuff. So they want to invest with you. Now, again, there are some investors, and every investor has this, I believe, but that want to chase returns. But if you can get ahead of that and you can create that great reputation that people want to invest with you because they like who you are, they like how you do business, they like that you're honest, they like that you are faith based, or that you give back to charities, or that you serve your communities in a certain way, whatever it might be. They like what you stand for. They like who you are, and they go, I want to invest with them because I trust them. I know them. I trust them. Um, and then they're going to, by the way, start giving you referrals, which is even better. Okay. Um, look, I think a big question every LP should ask a GP is, have you ever lost money on a deal? Have you ever done a capital call? Have you ever had give me a problem that you've had and how you navigated that problem? These are questions I think are really important. And to see how the general partner answers these questions. Do they tiptoe around the question? Do they go straight at it, and do they answer it? The last one is name a problem that you've had and how you navigated it with, is so important, because if they say, well, man, I can't even think of any, immediately you know that you can't trust them. If they say, yeah, man, we've had so many, let me give you one, and they answer it and they're straightforward, that tells me a lot. And if they don't give you maybe a good one that doesn't seem like much of a problem, ask them for another one. Hey, look, I appreciate that, but give me another example that was even more difficult than that one. I want to know how they treated that situation, how they navigated through that situation, how they came out in the end. And even if they didn't come out fully positive in the end, can they acknowledge that? Uh, the prior ones, like, look, have you ran out of money? Have you had a capital call? Have you lost money? I'm not as concerned about the answer to the question. I'm concerned about how they answer those questions. Are they answering it with honesty? Are they explaining themselves when they say yes or no? Are they explaining themselves? Are they telling you, do you feel like they're telling you the truth? And are they being fully honest with the question? Because the question isn't necessarily to say yes or no. The question is to get them to explain so you can understand how they think about business. You can understand how they act in business situations. That's the more important part than what the answer is. So, all right, a lot more questions that I get. I mean, I get asked. Look, I get asked so many questions, but just look, if you're an LP out there, you've got to think about what you're really concerned about, and think about what you really want with your investment. And so when you do start talking to GPs, you've got that laid out for you. My suggestion is talk to several general partner groups like ours and feel those groups out and make a short list of who you like the best and kind of follow them, follow their deals, get comfortable with them before you just jump in and invest with them. And especially if you can get some referrals, that's always great. So I think it's always best to ask the general partner for some referrals and actually call them and act on that too. That's really important. All right. That's it for me for today. I'm Todd Dexheimer signing out. Make every day a Saturday.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.